Today, I want to tell you about investments. We've been going through many different topics in finance, the part of finance where mathematics has an impact. And today is my turn to talk about investments. That's what I'm going to be doing now. I want to start by saying something about the concept of making money. What does that mean? We started this course with one statement, which is everybody needs money. And we went through that. We saw how bonds are priced. We saw how we can invest in stocks. We saw how derivatives arise. Then we saw how we can do risk management. We got into credit in great detail. Today, I'm going to focus on the concept of making money. What does that mean? And for that, I want to perhaps address one issue, which is the concept of making money has, I would say, two interpretations. And I will perhaps try to address both of them during this course. The first is the concept of investment activity, to invest to grow the money. And this is what most of you already understand, that making money is about. You buy a stock, you buy it low, you sell it high, you make money. This is typically what is understood as investments. But today, I'm going to consider also another alternative, which is actually bigger than that, which is actually what defines most of the activity in the investment sector, which is invest to make fees. What does that mean? If you invest your own money, you typically invest to grow it. But most of the investment sector is not. Investment managers do not invest their own money. If you get a job at a bank or a mutual fund, you're not investing to make more money for you. You're investing to make more money for someone else. And when you do that, the activity that is going to drive your actions is to make fees. I will explain that. We're going to understand that today. I hope we understand that today very, very well. There's a lot of ways of doing that. The investment sector is very large. It contains asset managers. It contains mutual funds. It contains pension plans, prop desk, family offices, and this and that. Most of them, the activity is to make money for someone else. And you do that because you get paid when you do that. In some situations, for example, family offices, you invest to make money for yourself or your direct beneficiary owners. And that changes what you do. Now, to make sure that everything is very clear, I want to give you an example. Today, in the first half of the lecture today, we are going to construct a fund. And I want to talk about investment funds, how they are conceived, how they are born, how they grow, and how they die. I'm going to go through all these 4 steps. I'm going to spend a lot of time on the conception, which is the why. How do we come up with the idea? And then we will see that from there, almost everything else follows, but I get into the details of how we give birth to a fund, how we create it, how it grows, why it grows, how can it stop growing, and how it can actually die. I want to deal with all of that. And my example is based on one case. The example I want to use today, like I said, we're going to create a fund. But this creation is based on a true story that happened in Montreal. I use this it's a nice example. I hope you like it. I've been using that for many, many years. And it has to do with something I learned about the city of Montreal around the year 2000. City of Montreal is, I think you know that where Montreal is. This is a talk that I give around the world, and some people don't know very much about Montreal or Canada. But I should tell you one thing. The city of Montreal spends well over $100 million a year cleaning snow. The city of Toronto spends not as much, but also quite a bit amount of money cleaning snow. And the way the snow is cleaned is very. I mean, for some of you, it may be familiar because many homes in Toronto are cleaned like that, which is the city does a public tender, and then you pay a flat rate for the months that you select your snow to be cleaned. Some of you may, for your home, your parents may have a similar contract. Typically, when you do these retail, you don't get to choose when the season starts and when the season ends. But the cities do have that because it's a lot of money. They spend well over $10 million per month cleaning snow. So they get to decide when they want the contract to start. And they negotiate that with companies. Turns out that around that time, the city of Montreal did the public tender as usual. And because the charge is so large on a per month basis, someone, I don't know who, I don't know his name, someone, perhaps a lawyer, had an idea. The idea is the city needs to make a very tricky decision, which is, I'll give you an example. Shall we buy the contract in the month of April? It's snowing in Toronto, it's snowing in Montreal right now. So one might think that it's a good idea to get the contract for cleaning snow in the month of April. The city of Toronto does not have April in the months where they want to clean up snow. Why? Because Toronto has learned that during the month of April, it's cheaper to just not buy the contract, or save yourself your $10 to $20 million. And if it snows, just wait, because in a day or two, typically in a day, the sun comes up and then the snow just melts. So why would you pay that? In the year 2003, which is probably the first year I actually used this example, in Toronto we had an issue. We had snow in April. April was not in the contract for the city. But the city of Toronto, after 3 days, was in total chaos. There was no delivery. Some supermarkets were running out of food. So the city had to call the cleaning company and said, clean up the snow. As you can imagine, they didn't get a very good price for that. And that year, the city of Toronto spent 50% of next year's budget on that single cleanup. So that was a very big price tag. They probably spent, I don't know, I'm guessing $60 million for a cleanup, a single cleanup. So this person had an idea. He said, look, the city has this risk factor, this decision to make. And ski resorts have the opposite problem. Ski resorts, they love it when they snow very late in the season or very early in the season. And they suffer when that's not the case. Around the same time, 2003 also, I think, Toronto had very late snow. And in Blue Mountain, you see here a picture of Mont Blanc. Blue Mountain, I remember that year, people, it was empty. There was only mud on the hills. There was not a single snowflake. So that's extremely costly for ski resorts. So this person had an idea, which is, here I have a city that has a risk of late snow, for which they can buy insurance, but it's very expensive, and a ski resort that has the opposite risk. So why don't we exchange risk with each other? Now, this is something that is not new to us. We've seen that. If this was a risk on interest rates, that would be exactly the same situation that we saw with Goodrich and Rabobank. But this is not something linked to bond prices. This is something linked to snow precipitation. So the deal that was proposed is a snow swap. The city, I'm picking very random numbers, 10 million, easy to work with. This has nothing to do with the original deal, which, by the way, I don't know the numbers that were used for the original deal. Okay, I just know that the deal died, that it didn't happen. I'll explain to you why. So let's say that the city says, you know what, I'm not gonna pay the $20 million for a given month. What I will do is that if I save the money and I am right and there's no snow, then I'll just pay money to the ski resort. Let's say half of that, just to be simple. The numbers are a bit silly, but you'll understand. On the other hand, if there is late snow and the city runs the risk of having to pay a very big price tag to the to the cleaning company, I'm going to get $10 million from the ski resort. They will be very happy to spend it because they're going to get additional revenue. Okay? See, what I need you to understand is the similarity between this deal and the one that we saw for Goodrich and Rabobank. No interest rates, no. This is what's called this is what's called a weather derivative. Okay, but I'm not talking about weather derivatives today. This just happens to be something that it's just a name, and it's a little bit of a business. Okay, now, what do you think happened with this deal? It looks like a good deal. I just made up the numbers. What killed the deal was something different, is that they couldn't agree on where to measure the snow precipitation. The city insisted in measuring the snow in the city. Why do they care if they snow in the mountains? So if they snow in the mountains, but they snow in the city, they have to clean it, right? And the ski resort insisted that the snow precipitation be measured at the ski resort, and they couldn't agree. And this killed the deal. Believe it or not, this killed the deal. So this is a true case. It's a good example of a credit derivative that could have been but wasn't. Now, what I want to do is I want to use this as an example to create an investment fund. And this goes back to the conception, how I think of an investment opportunity. Okay, I'm not going to buy stocks today. I'll do that next week. This week, I want to show you how investment opportunities occur in abstract terms, and I chose this example as one that from which we can learn something. So imagine I am there. I'm just witnessing this, and then I see that the deal died, and I see that it died for a very silly reason, which is that very likely the results of the measurements in the ski resort and in the city are going to be very similar, but they couldn't agree. So I'm going to step in, I'm going to say, hold on, no one leaves, stay right here. I'm going to propose a different deal. The deal I'm going to propose is one in which I do a swap with the ski resort directly using the measurement station, and I'm going to do another deal with the city using their measurement location. Okay, I exchange the same amount of money, 10 million, 1 million, pick a number, it doesn't matter, right? And then I do two different swap agreements. You understand what I'm saying? It looks similar to the Goodrich Rabobank, right? Except that now I am the intermediary. Now, why would I do this? Well, I do this for a fee. Let's say I'm going to charge 10% of the cash flows to do this deal. 10%. That means that most of the time I will just be exchanging payments between the city and the ski resort, in which case I just take money from one, give it to the other as a good swap, and collect the 10% that is owed to me. I collect per year $2 million. Okay, is that clear? All right. Let me ask if you like this. Anybody here is an investor? Anybody here invests? Maybe you want to share with me your investment sense if we tell you that this is a good deal. All right. Let's analyze the cash flows. I'm going to analyze the cash flows in the following way. I'm going to say that just to fix our ideas, I'm going to assume a 50% correlation between the city and the resort precipitation. You know, I love the 50% correlation number because we already know the probabilities of joint behavior. We saw that 2 weeks ago. So with a 50% correlation between city and resort precipitation, I get that there's a 75% chance that both swaps yield opposite flows. So we just collect our $2 million free. They say 12.5%. I actually received money from both. They said 12.5% chance I collect $22 million. But this is the killer. They said 12.5% chance that I have to pay both of them, which means I will lose $18 million. Okay, so these are the cash flows, which are mathematical. You see, they depend on a on an assumption, which is my correlation number, 50%. That number could be anything. I'm not trying to give you a very fine numerical description of the example. I just want you to understand the concept. And now the question arises whether this is a good deal. For that, what an investor would do is they would look at the investment parameters. So the first parameter is how much money I need for that. I need $20 million. What's my average return? 10%. So far, so good. I actually don't have $20 million. I'll deal with that a little bit later. Let's not worry about that for now, okay? Maybe one of you has $20 million and you want to invest. Now, what's the volatility of my investment? The volatility is 50%. I have the calculation rate here in front of you. The variance is obtained as follows. There's a 75% chance that I deviate nothing from the mean. There's a 12.5% chance I deviate a lot from the mean when I make a lot of money. And there's a 12.5% chance I deviate also 90% from the mean when I lose a lot of money. So the variance is about 25%. That means that the volatility is about 50%. We know how to calculate this. Am I right? So with that, what do we do? Well, there's a number. You probably already know this number. We're going to understand this number very well today. But for now, let me just say that if I take the division between the return, 10%, and the volatility, 50%, I get this number. It's called the Sharpe ratio. And that number is 0.2. Investors sometimes use this number to have an idea whether this is a good investment or not. And a 0.2 would be considered to be bad, very low. That means that I have a lot of risk. Frankly, if you look at the cash flows, the fact that it's a 12% chance I lose $18 million is pretty onerous. It looks like too much, right? So this is something which I would consider to be a bad deal. This is not something that I'm willing to do, okay? I think this is just a bad deal. But why am I telling you this? Well, I'm telling you this for two reasons. First is because for the first time, I showed an investment opportunity to you and the result is negative. We don't want to do that. But a really smart investor, in this case, will have another idea. And the idea is to build what's called a diversified fund. I would think while I am at that meeting in Montreal between the ski resort and the city that although I've done my numbers in my head really quickly and I know that that would not be a very good deal, I will still propose it because I hope I can do 100 similar deals with 100 cities and 100 ski resorts, say, across North America. Now, I need you to understand this. Why am I thinking of this? The first thing is I'm thinking that it is possible that in one of these deals I'll have to pay both the city and the ski resort. But how likely do you think it would be that I have to pay to both the ski resort and the city in a lot of these 100 locations? It's probably unlikely. In fact, with a little bit of probability, if the cash flows, the precipitation is independent at these different locations, I know what my numbers are going to be. So let me give you here the locations and the cities. This is just a list of some of them, okay? I have 100 of them. So my investment parameters are, first of all, my investment amount, which is now going to be $2 billion because it's 20 million times 100. I told you I don't have 20 million. Of course, I don't have 2 billion. But let me just write it there for now. Note that the average return does not change. It's still 10%. Now, this is the key. What's the volatility? The volatility is now only 5% because the volatility, the standard deviation, will decrease as the square root of the number of deals because these are independent. I have 100 deals, so from 50, I go to 5. And then if I calculate the Sharpe ratio by taking the division, what I get is that the result is a Sharpe ratio of 2, which is fantastic, fantastic. This is a very good investment. Now, let me make a few comments here. I think you understand what I'm saying. I hope you do. My first comment is, let's understand why these deals are independent of each other. Some of you may be thinking, sometimes people think that these deals are actually correlated because of global warming, for example. But note that global warming will only cause that I will have to give more money to the ski resorts and less money to the cities. But each particular deal, the risk I have is not related to global warming. The risk I have is related to the fact that the cities will have snow and the ski resorts will not have snow. So certainly global warming does not create such a strange meteorological effects where it happens to snow in cities and not in mountains, right? It must be something else. So it must be really random. And being random, I would say that it's actually independent of each other. And this is why I'm assuming that all of these cash flows are going to be independent of each other. Is that clear? Okay. Now, the second thing is my statement that the volatility drops from 50 to 5. That's because I have 100 deals. They are independent. So you know that when I sum 100 random variables, the variance does not grow linearly, grows like the square root of the number of random variables. We've seen that many times already. In fact, this was what led to our construction of Brownian motion. Remember that? Okay, so all of this is familiar to us. So it seems I found a very good way to invest $2 billion, right? Okay, wonderful. So this is what's called the idea. This is the conception. And many investment opportunities start like that. You have a vision, you have an idea, you have an opportunity, and now the idea is ready to be implemented. Now, what's holding me back? Only one thing is holding me back. I don't have $2 billion. And this is a very important distinction. I started my lecture today distinguishing between making money for myself or making money for others. If I am Elon Musk and I have more than $2 billion, maybe this is something which is return for myself and then I just do it. And this is something which, for example, family offices do, and it's a way of investing. By the way, some of you may be working in organizations that's what they do. For example, a pension plan. Canadian pension plans are wonderful investors, and they invest their money. I mean, it's our money, it's your money, it's the money of the pensioners, but it's their money. They have it, and then they invest to make that money. But most businesses are not like that. Most businesses have investment ideas like this one, but then they have to go out and get other people to give them their money. So I'm going to assume that today. I'm going to assume that because this is what most of you will be confronting. If you work, for example, in a mutual fund, in a bank, you work at BlackRock, they invest someone else's money. They don't invest their own money. So let me adopt that perspective because it does change very much the story that I want to tell you today. So if I'm investing someone else's money, if I don't have any money, what would I do? I need $2 billion. So what I should do is I should go out, talk to my friends, talk to potential clients, and see if I can create an investment business out of this. Okay, now let me pause here for a minute. I want to make my discussion today very realistic, very realistic. And let me say something. If I have this opportunity, how can let's say that I have friends with a lot of money. I'm personally acquainted with Elon Musk, Bill Gates, you name it. Okay, so it's a matter of making a few phone calls to collect the $2 billion, just to make things easier. Can I do it? How does that work? How do I collect $2 billion to invest in this? And second, and perhaps more important, even if I do that, even if I find a way to get Elon Musk and Bill Gates and others to give me the money, why would I do it? What's in it for me? This is the key. And this is what I want you to understand today. I want you to understand today how the investment process works and why would I do that. So what I would do is I have this great idea, I have these great connections, and I see I can create an investment fund. So what I would do is I am going to create a fund. So let me explain to you now what a fund is. A fund is, think of it like a company which contains a very interesting ecosystem of participants. The first one is the investors. The investors are going to put the money in the fund. So when I call Elon Musk, Bill Gates, and so on and so forth, I don't ask them to send me the money to me. I ask them to send the money into a fund. So a fund has to have a legal structure. Most funds are going to be based in the Cayman Islands, and I'll tell you why in just a few minutes. So, but I create a legal structure called a fund. I call it the Snow Fund. And I set it up, let's say, in the Cayman Islands, let's say. And then I call them and said, send the money there. And then I have my fund in the Cayman Islands, and it's going to have $2 billion. And the fund as a legal entity is something that now has assets that could go and write all of these 200 swaps. But to do that, and this is a very important step, I need to create a management company. The management company is, for example, a BlackRock. I need to create a company which is, in this case, it says owned by me. I don't have $2 billion, but maybe I have $100,000, which is what will cost me to create a management company. Why do I need $100,000? I need $100,000 because I need to register the company. That costs me $213 in Ontario. But then I need to hire a law firm that will register the company with the Ontario Securities Commission or with the specific regulator, wherever my investors are, so that I have a license to manage money. Not all companies can manage money. You need a special license. It's like a driver's license, but not to drive cars, but to manage money. Now, I'm not going to give you a course on securities law, but I want you to be aware that securities law is very relevant for much of what I'm telling you today. So that's what's going to cost me to create this fund and this management company. Now, the management company is going to work for the fund. The fund has $2 billion, but why would the management company work for the fund? For a fee. So the fund is going to pay a certain amount of money. I'll discuss this later, but the fund will pay a certain amount of money to the management company. And then the management company will manage the fund. Let's say that I am the CEO of the management company. Let's say I am the portfolio manager of the management company. Let's say I'm the compliance officer of the management company. These are all the rules that a management company needs to have. They need to have employees with these designations to be registered. And then I can manage the fund. Then I can go around the world, well, around North America, signing swap contracts with ski resorts and with cities. But that's not too realistic. Let me make my example very realistic today. And let's say I'm the CEO. My job really is not that. My job is really to take care of the business. So let me go through the different roles that I need for the management company. And I suggest that please pay attention to this because I want you to understand how these companies are established so that when you get a job in one of these, you understand what your role is. Okay? Because there's many different roles. Now, there's 3 positions I need right away. One is, 2 of them are required by law, and the third is required by the business. The first one required by law is I need a portfolio manager. This is a registered portfolio manager, someone who has the designations that the regulator in the particular jurisdiction needs, so you can be a portfolio manager. For example, in Ontario, you need to have a CFA. It's very silly, but you do. or an equivalent title. Okay, having taken APM 466 is not good enough. You need something else. Let's assume that you all have that designation. Do I have a volunteer, someone that wants to work for me as the portfolio manager, chief investment officer? I have a job opening as chief investment officer. Anybody wants to work for me? If there's one thing you should learn in my course is that if someone gives you a job offer, you take it. Okay, so Daniel, you're going to be my chief investment officer. Thank you very much. Okay, I'm going to hire a lot of people right now in the next 5 minutes, and I may forget your names and your roles, but you have to remind me. Okay, so my next position is I need a chief compliance officer. It's required by law. Let's say that you have a law degree. Okay, so you become my chief compliance officer. Think of it like the risk manager. Okay, so you're hired. But then I need a third person who is going to be key to my business. I need someone who is my relationship manager, my salesperson. Who wants to be my salesperson? Muskan, you're my salesperson. Great. You're going to be a great salesperson. Thank you. Great. So let's understand that a little bit. I'm going to have a salesperson whose job is to call Elon Musk, Bill Gates, and convince them that this is a good investment. By the way, you can only do that when I'm registered. If you do that before we are registered, then who knows, my chief compliance officer may go to jail. Who was my chief compliance officer? That's Henry, right? Don't worry. We're going to do things right. Muskan is not going to talk to anybody until we're registered. Okay. So with that, I can set up a company, but I'm going to need a few more people to help me out. Okay, as we will see, I'm going to start hiring people. Every let me move on through the ecosystem. I've hired 3 people so far. Now my fund is going to have is going to need other service providers. You're going to need a bank. A bank, for example, where to put the money. I have $2 billion. I need to put them somewhere, so I'm going to hire a bank. By the way, the bank may like us very much because we are now a very big client of the bank. Let's be aware of that. Okay, but my money will be in a bank. I'm going to need a broker. Now, in this particular deal, I'm doing no swaps. I don't really need to buy and sell stocks, but most funds actually buy and sell securities. They don't just do what I'm doing here. By the way, don't think that this fund I'm talking about is exceptional. If many funds are, for example, infrastructure funds, and what they do is they build an airport. They don't have to buy and sell stocks. Okay, they just need a bank, and what they do is they buy concrete or things like that, right? But many funds, they have to buy and sell securities, and for that you need a broker. So I'm not going to ask for a volunteer to be a bank or to be a broker. I'm not going to go that far, but you already understand these roles. You already know what they do. Now, here's a very important role. I need an administrator. Let me explain to you what that is. An administrator is an external company whose job is to count the money. Muskan is going to have to send periodic reports to the investors to tell them how well or how bad they are doing. Who will do the calculations for that? Who's going to calculate the value of our fund? Who's going to calculate if we make or lose money? Well, the answer to that question is very interesting. First, I need one person inside who's going to do that. I need a chief financial officer, an accountant that's going to count the money in my fund. Who wants to be my chief financial officer? Kirat, great, thank you. You're my CFO. Your job is to count the money. But who is going to tell the investors how much money they're making or losing? Are we telling them? Is Kirat going to tell them? How would the investors trust Kirat? Maybe Kirat is lying to them. The investors will typically like to have a third-party verifier of that. For example, like KPMG, a Pricewaterhouse, or similar company that is going to actually, I gave you names which are not exactly very good administrators, but let me say, you may not know them. Well, sorry, I use those names. Those are not good administrators. Citco, for example, is a better administrator, but you may not know who they are. There are companies whose job is to do that, is to count the money and report it to the investors. And then on top of that, I'm going to have an auditor. There I can have KPMG. There I can have Pricewaterhouse. They are auditors. They actually check that what the administrator tells the investors is correct. Look how important it is to count the money. And I'll make a comment about this. This is a very important comment. I already talked about this when I talked about risk management, but now is the right time to repeat this. This activity of counting the money, doing accounting, which is very rigorous, is recently, is quite new. It's only been around for about 100 years. Before 100 years, accounting statements were very dodgy. Now they have to be correct. If you lie, you go to jail. That's why there's so much oversight. On the one hand, I have my internal administrator, and I believe that's Kira. Then I have my external administrator, and then I have my auditor checking that all of my numbers are correct. Okay, and the ecosystem continues to grow, but this is the main aspects of a fund that I need. Now, I'm going to make a comment, which is that all the service providers, including the management company, need to be conflict-free. What does that mean? That means that these institutions should work independent of each other. We're going to mention in a few minutes a very famous example, some of you may know it, of one of the largest fraud cases in the fund management space, and that was Bernie Madoff. Bernie Madoff set up a fund. It's coming up later. I'll tell you now and then I'll repeat later. Set up a fund where the broker was the management company. He ran the management company and he was the broker. What did he do? If you are the broker and the management company, he created their own brokerage statements that were sent to the administrator. Those were fake. If you use a broker who is an independent broker, a Morgan Stanley, a JP Morgan, a Goldman Sachs, they're not going to do that. It's going to be very hard to get Goldman Sachs to lie for you. They're not going to do it. So this starts to get into the definition of what a good fund or a bad fund is. But I want you to be aware of these things because they're very relevant when you create these businesses. And even when you work at one of these organizations, this is something that you need to understand. Even if you end up working at at Canada pension plan, which is very likely for some of you, I still want you to understand that the fund structure works like this because this is the same products you're going to find when you move into a CPP, for example. Okay. Now, in this graph that I gave you here, there's a clear separation between what's to the top of the fund, which is the owners of the fund, the investors, and what's to the bottom of the fund, which are the service providers. The service providers, they all collect money from the fund. And the investors, they all put money into the fund from which all the money gets paid to the service providers. You understand? All right. The fund, in addition to that, has directors. What are the directors? The directors are positions which fall somewhere in the middle. They are the ones who have ultimate authority over the fund and they provide oversight to the fund. Imagine something bad happens to the fund. Like, for example, the management company is called stealing. The administrator realizes that they were stealing money, they were lying on their statements, they collected management fees that were not entitled to or something like that. The directors are the ones who can take over the fund, they can fire the management company, and they can try to recoup and send all the money they can back to the investors. So they have a very important role in this form. The management company normally is the one who has complete authority over the fund. They hire the broker, they hire the bank, they hire the auditor, they hire the administrator, they report to the investors the administrator statements, not their own. They make sure the auditor has deal with all of the issues and this and that. But on top of the management company, the ones who have power are the directors. Have you heard of the firm long-term capital management, any one of you. This is a fund. It became very famous in the year 1998 because it was a fund that blew up. They had several $billion of investors' money, and they lost nearly all of it. Not only that, they had, I think we've talked about them, and we'll talk about them again next week. There was a fund that had a very large position on the fixed income market in the United States. And when Bill Clinton was impeached in Congress and Russia defaulted on their bonds the same week and credit markets dried up, they had margin calls that they cannot make up. That fund had two very famous directors, Myron Scholes and Robert Merton, who had just earned their Nobel Prize the year before. Okay. Now, they were the directors, they were not the traders. This is something that very many people misunderstand. Okay, the directors have ultimate authority of the fund. They work as risk managers of last resort. Okay, but anyway, it just, I want you to understand the whole ecosystem of these funds. So, in a normal situation, I would have my investors, I will have my fund, I'll have all my service providers, okay? But let's say, I'm gonna give you a situation, which is, let's say I'm talking to Bill Gates and I'm talking to, I think Muskan who was my salesperson? It was Muskan, right? So Muskan is talking to, am I right, Muskan? You are my salesperson?
Yes.
Yes, exactly. So you're talking to Bill Gates, you're talking to Elon Musk. Each of them decides to give you $500 million, 500 million, only 500 million, okay? And the rest of the money is coming from two Canadian pension plans, Canada Pension Plan and Ontario Teachers Pension Plan, for example. Let's say that's the situation. It's likely, very likely, that both Bill Gates and Elon Musk may choose to invest in a fund which is domiciled in, say, the United States. Whereas it's very likely that Canada Pension Plan and Ontario Teachers will insist that you invest in the Cayman Islands. And I'll tell you why in a minute, okay? What do? We cannot have one fund for both investors. We need to put one in the United States and another one in the Cayman Islands. At the end of the day, we don't want to go and sign a deal with the City of Montreal and the ski resort and then having to decide which deal goes to which fund if I'm going to do two funds. Or even worse, go and sign not one contract, one swap contract, but have to sign two contracts, or even three if I have to do three jurisdictions. I may have, Jack Ma and his fund in Hong Kong, and I need to do another fund in Hong Kong, right? So the solution to that is what's called a master feeder structure, which is we create a master fund. Master funds are typically in the Cayman Islands. I'll tell you why in a minute. And then you have feeder funds that go into that. One could be in the United States, one could be in Dubai, one could be in Hong Kong, one could be in the United States, one in Canada, it doesn't matter. And you do that because investors typically have restrictions as to where they can invest. If you are it's called an onshore, if you are a US resident, you typically need to invest in a fund within the United States, or you could have a lot of problems with the IRS. So perhaps because of that, Elon Musk and Bill Gates decide to invest in a fund in the United States. If you're a Canadian pension, you typically don't want to invest in a fund in the United States or even in Canada. The reason is, if you do that, those funds, when they make money, they have the obligation to do what's called tax withholding. They are going to take, say, 20 or 25% of the net gains and send that to the tax authorities. Turns out that teachers and Canada Pension Plan, they are tax exempt. They are going to then have to go and start the process to get that money back, which is very costly, it's very slow, and they will choose not to do it. In fact, but you can't escape. So what they do is they would say, I'm going to invest in a tax neutral zone, for example, Cayman Islands, that does not have tax withholding. That's why they invest offshore. Okay, that's why many of these investment offshores exist, because they don't have tax withholding. So you go there, there's no tax withholding, and they can repatriate all of the money into Canada without having to do any tax withholding, and therefore no tax. They have to make tax declarations, yes, but the tax declaration is very simple. They are tax exempt. They don't pay taxes. So they get all the money. Okay? And because of that, you typically find situations where you have to create lots of different investment structures. Now, this is not something which I want to stress too much, but I want to the extent possible today, I want you to learn how these things work in practice and how interesting and complicated at the same time some of these investments could be. So you could have feeder fund that has two investors in it, feeder fund two that has different investors in it. You adapt the funds, the feeder funds, typically to the tax composition of your investors, and Muskan will have to decide that because she knows who the investors are. And then every one of these funds is going to have its own set of administrators and auditors. So as you can see, this whole ecosystem can be very, very large. And some of you may end up working in one of the administrator or even in some of the auditing firms that go here. So there's a lot of jobs here for a lot of people. That's how the investment sector works. Is that clear? Okay, so we've done that. And now I want to get into something very important. Very important. You will see how important it is. Why are we doing this? Well, I'm doing this because the management company is also going to make money. Not only the investors are going to make money, the management company is going to make money. So I'm going to assume that we've been able to negotiate with our investors that my fund will pay my management company 1% of the assets and 20% of the net gains. Uskan has been negotiating this with investors. They're all happy with that. So this is part of the fund offering memorandum, in which I'll talk about in a minute. So that's why I do it. Now, let me show you what this means in our particular case. Okay, I'm going to do a very simple spreadsheet that talks about the cash flows that go into this fund from the investor and manager perspective. So into the fund, how much money goes from the investor? $2 billion. For the manager, nothing. We don't invest in the fund. Money is made. Let's say that we make our 10%, which is our target. That's $200 million. That goes into the fund. How much goes into the management company? Nothing. But now the management company is going to start to charge money to the fund. We're going to charge $20 million because that's 1% of $2 billion. So $20 million leaves the fund and goes to the management company, say on a quarterly basis. Doesn't matter. Say annually, doesn't matter. We're not concerned with that today. But then there's also a 20% of the net gains. The net gains are $180 million. So $36 million will go to the management company from the fund. The net of all of that is that the investor is going to make $144 million. The management company is going to make $56 million. Or in percentages, the investor has a profitability of 7%, and the management company, of course, has a profitability of infinite because we didn't invest anything. We make $56 million. Okay, now this is the first perspective that I want you to have on the investment sector, and somehow to show you the distinction between investing to make money for ourselves, in which we collect everything, or invest money to make money for others. Okay, so in this spreadsheet, maybe I would like to do a very quick, maybe I should do a poll. Actually, let me see if I can do a quick poll here on. Okay, so I want to ask you which column do you like? Do you like prefer to be an investor? You prefer to be a manager? Okay, hold on. Most of you have chosen to be managed, but by a very small margin. First of all, I want to tell you that the $56 million, which by the way is per year, is the value of a good idea. That's how you should think about this. It's a value of a good idea with, of course, a lot of work. But we just created a new company. We just created an investment company, more than actually investment fund. We created an investment company. Okay. The 144 or the 7.2%, which some of you chose, but most of you did not, it's important to understand that you're all investors. You are already in that category, all of you. We discussed that also several times in this course, because by virtue of the fact that, for example, you have a pension plan and some of you have already made CPP contributions, that means that you're already in the investor column, maybe with only a few dollars. In my case, with perhaps a lot of money, because I've been making contributions to the University of Toronto a pension plan for a long time, right? So we're all investors, but we're all paying a manager somewhere for the benefit of getting that investor money back to us. So we've all been playing different roles. I want you to understand the meaning of this. Let me start with, you have to remind me who was what. Daniel, I think you were my first employee. Am I correct? You are my chief investment officer. What should your salary be? You agreed to work for me, but we didn't discuss your salary. What should your salary be?
1 million.
1 million? Okay. You want to be paid 1 million. Okay, so this is how you have to think about your salary. In which of these rows do you actually contribute? To which of these rows do you contribute? To which part of my business do you contribute? I have two sources of income: the management fee and the performance fee, right? The performance fee is yours,
Yes.
right? Sure, I should pay you something because without you, I cannot bring investors, right? So when you say $1 million, maybe I would rephrase that question differently. I would say, I'm going to pay you very little in relation to the management fee. I'm going to give you a very small fixed salary, maybe say $150,000 a year, something like that, almost nothing. But then I want to pay you a lot of money. Let's say I pay you 10% of the performance fee. That's better than what you asked for. Is it not? Well, it's better than what you said if you perform. If you are able to get me the $36 million, then you're going to make 3.6. And I'll be very happy with that, perhaps, right?
Mhm.
Okay. I mean, I'm assuming I have a small team. If I have a lot of people in your team, maybe I had to split the 3.6 with everybody in the investment team. But you understand what I'm saying. Your income is linked primarily to the performance fee.
But commissions?
I wouldn't say commission. Commission is different, right? Commission is usually a third party. Here is a compensation. So I'll give you a bonus, which is going to be 10% of the performance fee. How's that?
Sounds good.
Okay, so that's how you think about that. Henry was my second hire. Henry, you were in charge. You were my compliance officer. I need one, otherwise I cannot run my business. What shall I pay you?
Wait, so as the chief compliance officer, that's like you said it's like the risk manager or something?
Let's say you are the risk manager, you are the lawyer, you do, all of that, all of those things. Just keep me out of trouble.
That would fall under management fees, right?
Correct. Exactly.
Um, can I steal the entire cut?
Can you take what? The entire cut?
Can I take the entire cut?
Well, the thing is this. I imagine my fund raises and raises and has more and more and more assets. Shall I pay you more and more and more and more? I think I will pay you a fixed fee. I will give you $1 million, maybe two if you're really good. And I think that's about it. That's as far as I go.
Right.
All right?
So it would not be like, it would not scale from the management fees?
Probably not.
Probably not.
Probably not. Probably not. But how about Muskan? How much money do you want to make?
I'm thinking maybe a base plus a percentage of the management fee because my performance depend like my relationships with the
Absolutely.
investors depend on how much
Your
money we get.
income, that's right. Your income is going to come from the management fee and from the management fee only. So give me a number.
Maybe 10%.
Okay, fine. I'll go with 10%. So there you go. You get $2 million, right?
Mhm.
Yes, good. Okay, so let me continue. Uh, Kirat, I forgot your role. What was that?
I was the administrator.
Oh, you were the administrator. Yes. How much shall I pay you?
Um, so for me, I'm gonna say like my cut comes out of management because I'm just helping with the processes of everything.
That's right. So that's right. Your payment is going to be typically a flat rate. Like Henry, maybe if I have a lot of funds, I pay you a little bit more money, but it's going to be almost a flat fee. You're not going to be the high earner in this. Although you are the CFO, it sounds great, but maybe I pay you a modest amount, say $1 million, and that's it.
Make do with that. Yeah,
Good.
that
Well,
sounds good.
as your first job, it's not bad, is it?
I can go higher, but I'll work with
You
1
go higher.
million for
Okay. Well,
now.
let's stay with that. Okay. I still want to make some money for myself, right? And yeah, I didn't have any other employees. I don't think so, right? I think we're out. Okay. So this is important because see, what I want you to learn from this is when you understand what you do within the organization, then you know how to ask for money. It's very hard to ask for money if they ask you how much you want to get paid if you don't understand anything. For example, and this is a piece of advice I oftentimes give my students when they apply for a job. The first question I ask is how much money does that group make? And oftentimes they don't know. If you don't know, it's going to be very hard to ask for a salary. Use this example as a very simple example in which it gives you a frame of reference, right? How many people are in the team? What's your real contribution? What happens if you're not there? If you're really, really good, can you make any one of these numbers bigger? Because I would like to hear that. And that's how it will be very easy for me to be perhaps more generous to you because, in fact, I'm not being generous, I'm just being selfish, right? So think like that, okay? But now, this is an example of something much, much bigger that's going on because the offering memorandum is what controls how the fund works. So this is back to the fund, this is the one contract that obligates the fund to have a certain relationship with the investors. It talks about the portfolio and investment guidelines. So for example, in our case, it would say that we're going to do snow swaps and snow swaps only. Our investors, Elon Musk and Bill Gates, are very happy with this very interesting investment opportunity we found. But if now we start trading Canadian stocks, they're probably going to be very unhappy because they didn't expect us to do that, right? So it's going to be there. We will not be able to do it. The fees are there. The fees are included there. We will talk about evaluation principles and methodologies. But now let me talk about this for a little bit. Who was my CFO? That was Kirat, right? So Kira, let me ask you a question. How do we have to send our investors a letter every month where we tell them the value of our investments. So Muskan has to do that. Of course, that number is going to come from the administrator. They get to dictate, but all of this originates with you. So one of the things you're going to have to do every month is find the value of the snow swap because all the assets we have are snow swaps. How do we value the snow swap? We know how to value the 33-cent game. We've seen the Black-Scholes theory. We've seen how to price options and this and that. I've never told you how to price a snow swap. How do we do it? I know it's a very hard
For
question.
sure.
I know I'm exposing you, but I do that for a reason, okay? And I am very grateful that you accepted to be my CFO, by the way. We don't know. It's extremely difficult, and it's so difficult that the only answer, which is the possible one, there's only one possible answer, which is you value the swaps as 0. Some people think, and I've heard this answer when I play this game, that say, well, I look at the weather, you can't do that. Why? These numbers have real consequences because investors make and lose money based on that number. So whichever process you follow, as we saw in the case of risk management, you have to be able to defend it, say, in front of a judge. So how are you going to come up with a formula depending on the weather? We already saw that. How can the answer be the solution to a differential equation, for example? Cannot be, right? So for a swap, the only thing you can do is you can value them at zero. There's no other choice. And when finally you get the payment, typically at the end of the period after a year, then all of that cash you will count as cash. So this is going to be a fairly simple valuation exercise you will have to do because these derivatives that we have here can just not be priced. But sometimes you have derivatives which are very complicated and they need to be priced. And oftentimes you need to specify how they're going to be priced. You can't say, I'm going to price them with this stochastic integral, because we saw that in APM 466, that doesn't fly. You need to have a very, very detailed, easily audited process to price that. Now, the reason I'm telling you this is we've seen how to price options in this course. I want you to know that although what we have seen is true, and I try to give you a very realistic perspective on the pricing theories we developed, when you get to the actual details, you have to do this for a business, as a business, in a business context. Oftentimes, the reality can be very different from what we saw here. One thing is that the chief investment officer, Daniel, because of the calculation he has done, he sees that a certain option has a great opportunity because of something, but then the valuation could be completely different. Because the valuation is about informing the investors of the value of their investment. It is not about what I think is going to happen in the future, or whether it's snowing a lot and everything is going to be fine. I'm just not going to have to give money to ski resorts or something like that. You see what I mean? I want you to have this veneer of reality to the things that I told you in this course earlier on. I told you until reading week, we all work for free. We lived in a world of ideas. Now everything is going to become more and more and more real. Every week, things will become more and more and more real. Okay? And I want you to be aware of that. And then another thing that we'll have to specify is the liquidity provisions. And this is something that is going to be a joint effort by my chief investment officer. So Daniel, you're going to have to determine that. You will have to tell us if an investor wants money, how often can we give them money? So let's say Muskan gets a call. Muskan gets a call from Elon Musk and says, Muskan, I know I gave you $500 million, but I need $100 million like tomorrow. What will happen if that happens? Can you give me $100 million? Daniel, can you liquidate $100 million of this portfolio by tomorrow? No, you cannot. Because you are locked into contracts which are at least a year long. So we're going to have to specify in the offering memorandum that investors can only ask for their money, say, in the month of August, but they have to tell us 6 months in advance. See what I mean? And this will come from you.
Yes.
Anything other than that can get us into really serious problems. And in fact, Henry, the compliance officer, is going to have to make sure that what we are representing to the investor that we can actually do. And then he's going to inform Muskan as to what he can tell the what she can tell the investors that the restrictions are. You see, that's a real investment firm. That's what we're doing. And everybody has a role to play. And it's very important to understand that, especially the parts which go outside of your normal boundary. That is how you can progress inside an investment organization. And that's how you can stop doing spreadsheets in the basement of some mutual fund and escalate to the positions which is where the good jobs are. Okay, so this is something which is given to the investors. Muskan will have to make sure every investor has read it. Okay, we don't want any liabilities. Oh, no one told me I had to read this, right? Something like that. And they have to be in agreement with the terms. The minute they invest, they're going to have to sign that they agree with all the terms. And that's how the investment process works. Okay, now I know many of you have invested in mutual funds and say, oh, in a mutual fund, I never had to do any of this. Well, you didn't, because the mutual fund law implies that all the things are already done behind the scenes. The mutual fund companies have agreed to certain processes. And when you invest in the fund, there's a declaration that you say, I know that I've read this and I agree with everything. Okay, so this is always there somewhere. Okay, sometimes it's very front and center, especially in one-off deals, like, for example, when you invest in a hedge fund. And for many investments, which are just very common, like a mutual fund, they are written somewhere in the law and then you're supposed to have read it. It's always the same. Okay. Now, let me give you, let me start to get into some of the risks that we have and the possibility of death. We already discussed this. What would happen if someone wants to redeem early their investments? We saw that it cannot be, so we're going to put those conditions into our offering memorandum. This is going to happen. We already discussed that. But now let me say that we're great. We're doing fantastic. And the size of an investment company is reflected in this quantity called assets under management, AUM. For example, let me ask you a question. What is the AUM of Canada Pension Plan? Can someone tell me? Can you ask ChatGPT or something? Tell me what the number is.
180 billion.
There you go. 780 billion. That's quite a bit of money, right? Okay, that's the assets under management, and the bigger you are, because the 1% management fee, the more money you make. Now, Canada Pension Plan is not a for-profit organization. They don't make investment fees or management fees. The employees are paid with some formula that comes from there, but the organization itself does not have that. But can someone tell me the AUM of BlackRock?
14 trillion.
14 trillion, right. So what's your guess as to how much money BlackRock makes per year? Let's say, I mean, I like to say that the investment business is a 1% business. Of course, many of their funds, they don't charge 1%, they charge a lot less. Many of them are very simple ETFs. But I would guess that on average, they make about $100 billion a year, 1%. Right? But that's the AUM. And as companies grow, they make more money. With more money, you make more fees, but then also you have to have higher capacity. What is capacity? Capacity is your ability to manage a lot of money. So let me give you a realistic example now. The example is one about how big our AUM can be. Let's say that we have the snow fund. It's great. We have 100 swaps on the cities and 100 swaps on the ski resorts. It's great. And that means that our capacity is $2 billion. But let's say that Muskan is going to your dinners with investors and you meet other investors who are not in the fund and say, I have a lot of money and I love, Elon is telling me that your fund is doing great. I want to put money into the fund, right? What shall we do? Shall we take more money? Our capacity is $2 billion. Let me show you what happens if I take more money. This is the spreadsheet that we have with 2 billion, right? Imagine I now accept 4 billion. So by the way, Muskan will be very happy because now, how much money you were making? I forgot. 10%? So
10%.
You're going to make now, wow, look at that. The 200 million is the same, but now you're going to make $4 million a year. You'll be very happy. You're going to do everything you can to convince me. I'm the CEO. I get to decide these things. You're going to try to convince me that it's a great idea to bring in more money. You would like that, right? Yes, you would like that. Exactly. Good. Now, what does my chief investment officer think? Well, the performance fee is going to become a little bit less, right? Because now I only made 200 million, same as before. I have no more swaps, and I now have a bigger expense in the management fee. Muskan does not care because some of that goes to you, but now the performance is a bit less. So maybe I get a warning from the chief investment officer, but that's because in this case, Daniel is going to be paid a percentage of that. So he's going to lose approximately $400,000 per year. So maybe he doesn't care, maybe he's unhappy, right? But there's a bigger issue, which is, by the way, it looks like I will be very happy because I'm making now $72 million for the firm. And it's my company, so a lot of that will come to me. But now I have a problem. Look at this. My profitability is going down to 3.2%. From 7.2 to 3.2. I don't think my investors are going to be very happy with that drop, right? Do I care? Now, this is a very important question. Who in the firm cares? Maybe I care. Look, if I'm very old, I said, you know what? I don't care. I'm going to retire next year anyway, so that's the end of it, right? But if I'm not planning to retire anytime soon, this is the end of my business. So I had a wonderful business making $56 million a year. And I'm swapping that for making $72 million in my last year. It's a business decision. I think I will probably not do it. Who else in my firm cares about this?
I don't care because I'll have to explain to the investors.
Yes, you'll have to explain to the investors. Of course, the explanation to the investors is a little bit easy for you because even if they don't believe you, you're going to make $2 million more. But then you have to find a new job too.
Yep.
Right? So if you're smart, if we are smart, we'll probably stay the same and say, you know what, I'm close. I don't want to take more money. I know that it looks like it's a good deal in the short term, but especially you're young. This is a great business for you. You can make $2 million a year forever, right? Until someone copies the snow swaps and then we have competition. But it's good. You're going to end up with a great reputation, and probably Elon will buy whatever you offer him again in the future if you have to change jobs, right? So this is what's interesting because, see, I want you to understand that investments is not about buying and selling stocks only. There's a business behind it. And that business, well, it can be your business if you're the one running this, but most likely you will be an employee in that business. And I want you to understand how these firms work, how they make money, because that's how you make money. I cannot say that often enough. Try to find out where in the business organization you are, because that will help you understand what your money should be. Okay, so let me talk about death now. How do funds die? Well, one of them could be, we just saw that. I mean, we increased the AUM, my performance drops because I was silly, and then investors say, you know what, I have better things to do with my money than to make 3%. Then we're out. But there's other ways. Fraud is one of them. Performance drop, we just saw that. A blow up, like long-term capital management. We're going to see a lot of these things, especially next week when I will be talking about trading strategies. Okay, or simple. Some people just don't like what we do, and they, just my funds blow up. This is the example I told you earlier. I can now give you a bit more information about that. This is a $65 billion fund that was lost to Bernie Madoff. There's something very interesting about this case, and I believe I have on the website a letter that I suggest you read. Now that you've seen these things, read the letter, and it's good information for you to understand how investments work, real investments work. This is a letter written by Markowitz, an analyst, a consultant, who explained to the Securities and Exchange Commission in great detail why he thought Bernie Madoff was a case of fraud. It was a very famous Ponzi scheme. A Ponzi scheme is when you collect money from investors, you claim you have great performance, but in fact you don't. What you do is if someone wants their money, you give money that you collected from the previous investor. Okay, you never had any money, but that's how you do it. So this is what this was. Markowitz was convinced that it was a case of fraud, wrote to the Securities and Exchange Commission. The letter is public. It's on the website. You can read it. And by reading the letter, you will understand. It's a great way for you to understand how these things work in practice. Okay. And what happened is what I already told you. He was the broker. This is one of the guys who created the NASDAQ index. So not the NASDAQ index, the NASDAQ exchange. He knows very well. He's dead now. He knew very well how trades work, how they're settled, how brokerage statements are done. So he just faked all of that and gave it to an administrator company that he was the only client for. This is a company that managed $65 billion with 2 employees. Goes to show that they were just rubber stamping statements that they probably suspected were false, but they just collected the money anyway, right? So this is a case of death, and funds can die for good, typically for bad reasons. If you have a good business, well, you can lose performance, you can lose interest, who knows? But the case of fraud is something which is here, and it's. But there's another very interesting way to die, and I want to explain this form to you. Is what's called a blow up. And I want to put this into context of our fund. So let's say that Daniel, my chief investment officer, is having breakfast one day, close to Christmas, very relaxed, it's no problem, and then reads this piece of news in the Global Mail, report on business. There's an article, the title is, How Did Interwest Rack Up So Much Debt? And then he becomes pale, he drops his sandwich at breakfast and said, oh my God, what's going on? This is the article from the Global Mail. What's going on? Well, what's going on is that he knows, he's my chief investment officer, he knows that this company, Interwest, is the owner of all of the ski resorts in our swap portfolio. What's going to happen if Interwest goes bankrupt? We already saw that last week. If Interwest goes bankrupt, do you think we're going to collect money from our swap agreements with the ski resorts? No. So at that point, Daniel starts to pray for global warming. Why? Because if it's very warm, he's going to have to give money to the ski resorts, which is good. Remember, he does not want to receive money from a bankrupt company, right? But let's say that the prayers don't work, and some funds just you cannot collect on some of the swaps. So we still collect the $20 million management fee, no performance fee. So Muskan, you still get paid, okay? Daniel does not get paid, just the base salary, whatever it is. Sorry, no performance fee that year. But the investors lost $80 million. That's the end of our business. That's the end of our business. We don't lose anything. We still make money. I'm still making money. It's perhaps the last paycheck I get. But that's how it works. That's another example of death. And in this case, it's very interesting because this is not a risk that we suspected might happen. That's very bad. We just finished a lecture on credit risk last week. We should know, don't you think? Well, that's how things are. So at this point, having said this, they say risk taxonomy. I'll just go through this very quickly. We've gone through this already when we went through risk management. We have market. We lose money when things go down. Credit, we lose money when people don't pay. Liquidity, we lose money when we can't access our money on time. That's what happened with long-term capital management that I told you. Gap risk, ignore it. Legal risk is they change the laws on us and then we're out. And we went through the example of Bankers Trust a few months ago. And operational risk, fraud, we just saw that. So these are this is the taxonomy of risk. And at this point, I have to say something. I want to end this very quickly. We're going to take a break, and then we'll come back and just start to do some math. How we can bring math in a bigger way to what we just did here. So I want to tell you the difference between speculation and arbitrage. First thing you need to know is you cannot obtain returns without taking risks. That does not exist. But risks can be mitigated by hedging or diversification. Okay. We just saw the example of diversification. We've seen the example of hedging throughout the rest of this course. So these risk mitigation strategies we can control. We are very good at that now in this course. We've been learning that. So if I can obtain a certain return and my risk goes down, and my risk maybe goes way down, I can say I can obtain fantastic return by taking very little risk. This is what's typically called arbitrage. So I know that we saw an academic definition of arbitrage in the part of this course where no one was making money. And that was very strong. These things don't typically exist in practice. In practice, when someone says arbitrage is when you can make returns with lower than expect or lower than normal risks. If you're very good at risk mitigation, then you can obtain what might be called arbitrage. And we're going to see examples of that next week. Let me just drop that term there for you. And one good source of arbitrage is market inefficiencies. For example, there's no swap. We were the first one to realize that. We exploit that. Maybe people catch up with what we're doing and they say, you know what, I can do a better deal. And then at that point, they come and they give a better deal. And remember, that's how we remove arbitrage, through a convergence to equilibrium in the prices. Okay, so in this case, I could have a situation of arbitrage for maybe 2 or 3 years, after which my competitors may find out, maybe someone with more convincing powers than Muskan can convince the investors to invest in their fund in only hours, okay? Or maybe some other reason. Maybe my chief investment officer, Daniel, is less skilled at negotiating good swap deals and we lose the business to someone else. But that's how we converge to pricing. We saw that in the first part of this term. And that's how these things happen in practice. Very different from what we saw earlier, but the abstraction is the same. Okay? All right. So now there's a very interesting discussion that I'm not going to do. I want to move on to another part of this lecture today, but I want to just open up a conversation so you see how deep this well is. And let me go back and adjust one assumption we made, which is I said we need $20 million per swap, and we accepted that. Why? Well, the answer is very clear. If I have a risk of up to $20 million to give to my investors, then I was assuming that my counterparties, the ski resort and the city, would require that I have the money. Right? Makes sense. But why didn't I do the same? We just saw that if the ski resorts go bankrupt, I don't earn. They don't pay. And I never asked for their 10 million upfront. So this gives rise to a very interesting negotiation. And this is what the chief investment officer must do, which is to say, you know what? I'm not going to do the swap deal with 20 million. I'll do it with 10, for example. And by the way, Citi, you have to put $10 million too. And maybe it works. If it works, I decrease my credit risk exposure tremendously because I get them to put collateral onto the deal. And by the way, if I go from 20 to 10 of my investment amount, my performance goes up by a factor of 2. And I'm actually not taking more risk, I'm taking even less risk. So we just saw that we ignored the risk, but now we also see that we ignored an opportunity. And then in a real investment situation, we need to take into account all of those things. And Daniel, my wonderful chief investment officer, must be aware of all of those things and negotiate fantastic deals where we put very little money, so my risk exposure is lower, where my counterparties put a lot of money, so my risk exposure is even lower, and then I have a fantastic fund. You understand? But now we have a lot of things to work with, and this is in an investment that seems to be very simple. We're going to see much more complicated investments next week. We'll see convertible arbitrage and who knows, right? But I just want you to be aware that you just gotta be smart. There's a lot of parameters that you can play with, and I want you to be in very good control of all of them. Okay, so I'm not going to do any more of this. I have a lot of things that you can read them. Okay, I'm going to talk about leverage and this and that, and I'm not going to talk about that. Okay, I'm just going to let you know that I have, and this is a very interesting exercise that I suggest you do if you care about this. But I want to now stop here. I want to have a very important thing to talk about. You can do that. And I want to now, again, this is just exercises. I'll leave them here for you. They're interesting, okay? But what I want to do now is I want to start to develop some of the quantitative techniques we will need to understand investments. Okay, we've mentioned them already in so we created our fund, by the way, and we became very wealthy for a few years, right? Now that's the end of that. It's time to go back to school. We're going to take a 8-minute break, okay? Short one, I want to continue. And then in the last hour, I will review some of the basic investment techniques we need to be able to do all of this. So in this last section, I want to give you a mathematical definition, if you will, or at least a description, mathematical description of some of the topics we have used already in our example today, so that we know what we're talking about. Very likely there's nothing new in these definitions, but I hope to end with something that might be new, which is an understanding of how we understand some of the quantitative numbers I've defined here. So the first I want to start is reminding you of the definition of return. Return is the value of my investment, stock, fund, shares, anything, today minus what it was earlier, divided by the value we had earlier. And that is return. The normal return, the one that we've seen oftentimes. Now, we've also encountered the log return, which is slightly different. It's the logarithm of the ratio, or in other words, the logarithm of 1 plus the simple return. It's exactly the same. And we know from Taylor's theorem that for small returns, these two numbers are going to be close to each other, okay? And this allows us to collect numbers on a monthly basis, daily basis, annual basis. This gives us a time series, and that unleashes all the power of mathematics, probability, and statistics to draw conclusions. Great, that's how we start. Now, once we have a time series, all these numbers are going to be used usually through the portfolio statistics perspective. So I'll briefly review for you what that is. Once I have a time series, I can build my cumulative return distribution, which is defined as the probability that my return is less than or equal to a certain number x. And as x goes from minus infinity to plus infinity, the function grows from 0 to 1. Okay, great. Its derivative is, by the way, this is the same function that gave rise to the value at risk that we defined a few weeks ago. I can also look at the derivative of this function, which is the return density, or if you use Excel, that's the histogram. Okay? These are two functions that help us understand the probabilistic distribution of my set of returns. Great. So with that, I want to start with my first so-called definition. It's not really a definition, but let me tell you what it is. The average return is obtained by taking the mean of the values that I observe. Let me leave it at that for now. Okay? I observe my return on a, say, daily or monthly basis. I sum for all the months or days that I have, and that gives me that. And the volatility, which we already used earlier today, and we've seen, of course, throughout this course almost every single day, the volatility is obtained as, well, the central second moment, as you know. Now, I need to make a very important distinction here. The distinction I need to make is that these two expressions in front of you, for those of you who know good statistics, you will know that these are not definitions. You will know that these are estimators. You would know that the definition is actually something which is done in probability space, in the world of ideas, not in the world of numbers. They are done in heaven, not on earth, okay? And they are defined as we have in the blue rectangle. What I have on the right is the estimators of that. Now that requires, I like to call this heaven and earth, that requires that there's a relationship between heaven and earth. There's a relationship between what I observe in Excel and what happens in the world of ideas. They must be related. Mathematics, probability, and statistics guarantees that in this case, they are related. Now, there's many situations in finance when they are not related. And this is one of the main sources of mistakes that portfolio managers, professional portfolio managers make. And that's not something I'm going to address very much today in my talk. It is something which I just want you to be aware of, okay? Now, there's other things to be careful about, and I have here an example which I hope is illuminating and will give you some understanding of what I'm doing. Imagine I have a fund which I start on my own with $1, okay, but I'm a great investor, so I make another $1, I make 100% return in my first month. And I'm such a good investor that the next month I lose half of it, okay? And then I make it back and then I lose it. And then I make it back and I lose it, and so on and so forth. So for the whole year, I'm making $1, losing $1. There you go. Okay, see that? Wonderful. What does that say about my investment? Well, let me look at the statistics. The statistics is that my average return is 25% per month. Yes, my logarithmic return averages to 0, but my simple return is 25% per month. So what if I hadn't shown this to you, and me or Muskan, my salesperson, would try to sell you an investment that makes 25% per month? Would you be interested? Well, you might have been interested until you saw this. Then you probably lose interest. So what's going on here? What's going on? What's going on is that this risk that I have here, the standard deviation is very high, 75%. So perhaps this rings a bell. Do you remember Ito's lemma? What did Ito's lemma tell us? It told us that if I have a logarithmic time series with a certain mean and a certain standard deviation, in our case it's 0 and 70%, the exponential of that, in other words, the simple return, is going to have a drift, a volatility which is the same. As you can see, it doesn't change much from 70 to 75. But Ito's lemma told us that the drift is going to be sigma squared divided by 2. Remember that? Well, sigma squared divided by 2 is remarkably close to 25%. So what you're seeing here is a consequence of Ito's lemma. Now, if you don't know Ito's lemma, or if you're not a mathematician, or both, you may be led to believe that a fund with 25% average return is good. And I like to show this as an example. I may have told you, and I like to say this very often, that the superpower many of you have as mathematicians is not that you can calculate many, many things which are very complicated. Is that you can detect when someone is lying to you. And this is perhaps a very good example of that. So that's the example I want to leave with you, okay? Now, having said that, of course, the mean and the standard deviation are things that we can calculate, and I have here an example how we calculate the mean on a rolling window from here to there. But let me focus on, let me tell you what this is. There's something that I also want you to be aware of, which is don't think that mathematics is more powerful than it really is, okay? That's another common mistake that people make. So the exercise that I did here, I took some investments, doesn't matter what they are written down there, but that's not important. And then I looked at the 2-year window and I calculated the mean of my investments over a 2-year window. And then I move that window by a day and I do the same thing. And then I might move that window by another day and I do the same thing. And I do this for a period of a few years. What happens when, when I do that? What happens when I do that is that I see my numbers, my average is going up and down. Now, what does that mean? Well, what that means is that, in fact, this number I'm looking at is not stationary, and therefore maybe this approach I had to calculating means and standard deviations is not correct. In fact, what this means is that the process I have here is not identically distributed, and therefore that's where I get different numbers. So that means that many predictions I would make are going to be very bad predictions. Let's be aware of that. But let me go into this example, which is perhaps more revealing. It's the same thing, but now for the standard deviation. I take a window, calculate the standard deviation, and then I move it by a day. And I get this. And my question is, what's that? What's that? Some people may be led to the conclusion, people that don't know math, may be led to the conclusion that this is a period of high volatility. But isn't that strange that it happens to last exactly 2 years? Which is precisely the length of time I chose to calculate my standard deviation. What's happening is that this was the beginning of the financial crisis. We had very bad events, in particular one very bad event on one day. And this is what caused a very big outlier, that when you use the estimator for the standard deviation, as long as the outlier is in that sum, you get a big number. But 2 years later, when the outlier leaves the sum drops. Does it mean that the standard deviation magically dropped after 2 years? No, this is a numerical artifact. So mathematicians, especially if you have experienced programming, will know that these are numerical artifacts. So it's very important to understand when the math is misleading and when it's not. And it's not that math is wrong. Math is never wrong. Math is always right in heaven. But when we bring it down to earth, it can be very misleading. Once you feed it real numbers and you get real graphs like these, it's very easy as humans to misunderstand it. Now, machines will have a different perspective. And I give here what would happen if I look at the same data that I gave you earlier, but I disorder it. In fact, I remove the time component. I remove the time feature. What I have is this. And now I can see that suddenly my data looks to be very neatly organized into 3 investments, one which is of high risk, one which is of medium risk, and one which is of low risk. Risk is on the x-axis and return is on the y-axis. Forgot to say that, right? So suddenly those disordered numbers I had earlier have some meaning. And this is what classification trees would do for you. We went through that already, I think in the second or maybe first day of class, I forgot. But this is another good example of that. So the reason I'm telling you all of this is I want you to have a realistic view on what works and what doesn't work and how easy it is to mistake one for the other. Okay? All right. Now, things get even crazier if I look at returns over time. Most investment funds would use a definition of return over time, which is as follows. You just compound your monthly returns or your daily returns over time. So if I have a certain return for a period, say I'm going to pick a month, okay? First month, second month, third month. Then you just compound all of them, and that gives you a time-weighted rate of return, which everybody uses in the investment sector. Now, let me give you another example so you can see how misleading this can be. I have a fund. I start with $1. Let's look at the first column, the fund balance first, okay? I have $1. You can see I have an inflow of $1. So the $1 I have is not because I made it. I didn't have any money, so it's clearly just an inflow, all right? But then I have a P&L of $1, which is a monthly return of 100%. Therefore, I go to February with $2. I have no more money. No more money is coming into my fund. But now I have a P&L of $2. I'm good. So my fund starts March with $4, no inflows, but I make another $4. So every time, every month, I double my money without taking new money in. All of these are gains. My P&L is just making me all this money, and every month I have 100% return. And then I reach the month of November with $1,024, and I made another $1,024. I double again. But at that point, Muskan, who's in excellent relationships with Elon Musk because she's made so much money for him, she gets a call. She said, do you know this guy who has this fund? Let me give you $1 billion. And then I take $1 billion from Elon Musk and I lose half of it. Elon will not be very happy with me or with Muskan, but that's not the point right now. The point is, my monthly return is suddenly 50% in the month of December. What does that do to my total return? Well, look at my cumulative return. My cumulative return is 102,000%. But if I look at my cumulative P&L, I've lost $500 million. How's that possible? Well, there's no contradiction, right? If I have very good percentage return when I have a little bit of money, and I have very bad return when I have a lot of money, I know that the impact in dollars is going to be very bad, but the impact in percentages is going to be very good. You need to understand percentages. See? So my time-weighted rate of return is fantastic. I will win the Manager of the Year award if they look at that number. But is that the right number to look at? Well, because of that, there's another unit to compound returns over time, and it's called the internal rate of return. And it takes into account how much money was going into my fund and how much money I have at the end of the fund. And this is the formula that I have here. And what is most important to point out to you is that the internal rate of return is defined as implicitly as the number R that would make this expression be true. Now, what is this expression? Let's look into that with some care. P is the cash flows that go into my fund. Could be inflows, could be outflows. R is my unknown. And you see it's compounded on a monthly basis with monthly compounding, not instantaneous compounding. That's how these things are done in the investment sector. I'm not going to do instantaneous compounding when I'm talking about these investments from such a practical point of view. So the end result of all of that is the value V that defines implicitly what the value is. I just observe. I ask my administrator, the accountant will give me that value. So the accountant knows P, the accountant knows V, the mathematician knows R. Is this formula familiar? This is how we define the yield to maturity of a bond. And I told you I didn't like this definition for a bond because it didn't help me understand the value of time. And it was useless in an arbitrage-free context. But for an investment, it's very useful because I want something which is investment related, not related to time or something else, right? So the yield to maturity that was useless for a bond is actually very useful for a fund. And if you redo the previous exercise with this definition of return and you solve this equation, you get as suspected that you see how the expression here, you get as suspected that the internal rate of return on my fund is about minus 50%, which somehow agrees with our intuition. You see that? Okay. So I want you here to be aware of all the new nuances that doing quantitative analysis on funds gives rise to. It is very easy to misunderstand. It's very easy to mislead people. In some lengthier courses, when I teach this, I give examples of how I have witnessed over my professional career attempts of funds to use statistics to mislead people. It's a very big industry. And I just give you some examples, hopefully to alert you that you have to be very careful. Okay, now I want to move on. I don't want to stay here too much longer because now I want to talk about relationships. As we have found, the key to making good investments oftentimes lies in understanding relationships. Like in our snow fund, it was key that we did a portfolio of 100 swaps because with less, the portfolio was not attractive. And the correlation and the covariance that you already know is the key to that. Now, I want to remind you what the formula is. This is the heavenly formula. It's the theoretical one, the one in the world of ideas. That's the one which is implemented in Excel. And Excel will do it for you. Okay? And the correlation has the advantage that is the division between the covariance and the product of the standard deviations has the advantage that it's a number which is relative. You see, it's the division of covariance by the individual risks, so it's between -1 and 1. So it's very convenient for us to use. And you use that, and your assignment number 1 dealt with that. But with the covariance matrix, I can calculate the covariance of my portfolio. Because my portfolio consists in investments in a number of assets with weights given by W and assets given whose return is given by random variables that I denote by X, then my portfolio, which is the linear combination of the allocations to each of the assets, its portfolio variance is the dot product of the portfolio with itself. And you perform these operations that you have here. I think you've seen this many times. In fact, we already used this when we calculated the standard deviation of the sum of Gaussians, because that's exactly what I'm doing here. That tells me that the portfolio volatility is the square root of the product, the matricial product of my allocation vector with the variance covariance matrix. And here I can see the value of diversification when the diversification is high. In other words, when the correlation is low, the risk tends to come down. Markowitz, who is the one who discovered a lot of these things and whose name I'm going to pronounce many times now in the next few minutes, called this the only free lunch that exists in financial markets. Okay? So Markowitz, in the year 1952, I think he was a graduate student at Stanford, he's the one who, for the first time that we know, came up with the concept of risk. He was probably not the first one to talk about risk and return, but he did it at a time when talking about expectation of return and the expectation of standard deviation was soon to be calculated because computers were just around the corner. The first computer, as we understand it today, was built in Princeton at the Institute for Advanced Studies in 1951. It still was just one computer, but Markowitz came up with this theory in the 70s. Computers started to be used by professionals so people could implement the theories that Markowitz came up with. If he had done this 20 years earlier, no one would have listened because these are not calculations you can do with pencil and paper. With pencil and paper, you can calculate returns. You can calculate accounting information. You can see this company is cheap, this company is expensive, because you rely on the financial statements for that. But to do time series analysis, you need computers. And this is the reason that Markowitz's theories became so successful. He got the Nobel Prize in 73 or something like that for his theories of 1952, which I want to review with you now, okay? But in a very practical framework. I'm not interested in his original derivation. What his argument was, if I take a portfolio and I calculate the risk defined by the standard deviation and the return defined by the expected return, and I put that on a plane, I have two numbers, put them on a plane, that will help me understand what I'm looking at. This is the typical curve which is used for that. This is called the CAPM curve, where I see what happens to a portfolio that starts with 100% bonds, and then I start removing bonds and adding stocks. Bonds have less standard deviation than stocks, so no surprise, the risk continues to go down. The return goes down too because bonds have less profitability than stocks. All of that is fine, and we're not surprised by that until we get to that nose. In that nose, I have 75% bonds, 25% stocks, and I see that if I go to 100% bonds, the risk actually goes up. Why? Because I lose the diversification effect, which is not very strong, but is strong enough to tell me that the optimal portfolio is actually not 100% bonds. That is a suboptimal portfolio. For all practical purposes, 75% bonds, 25% stocks is better than 100% bonds. For other choices, above 75% bonds depends on your risk appetite. If you have a high risk appetite, sure, go to 100% stocks. But for sure, the 100% bonds portfolio is suboptimal. So this gave rise to the concept of optimality, right? And what he said is, if I look at all the possible investments I can make, and for every investment I put a dot on the plane, I have a subset of the plane which defines my investment opportunities. In other words, I have two spaces, subspaces of the plane. One is the realm of possible investments, and one is the realm of impossible investments. And then he argued that rational investors will invest at the boundary. Because if you're not at the boundary, your investment can be improved by either moving horizontally, lowering the risk, keeping the same standard deviation, keeping the same return, or moving vertically, keeping the risk and improving your performance. That was his thinking. But he never told us where in that efficient frontier one should invest. He just said we invest in the coast. but not where. For that, the one who told us where to invest is Sharpe. And Sharpe told us that we should invest at the point that maximizes a certain ratio. We already saw the Sharpe ratio. It's essentially the expected return divided by the standard deviation. But what I want to do now is I want to play a little game with you. Another game. This is the game which I have to tell you, when I started to learn this Sharpe ratio in particular as an academic, I never understood. I know that the definition is there and everybody's talking about it, everybody's using that, it's in the books. But I didn't understand it fully until I opened my investment company. Because when I opened my investment company, I saw how people get paid. So what I want to do now is I want to show you the relationship between employment contracts and Sharpe ratio so that you all understand how important the Sharpe ratio is. Okay. For that, I need to hire 2 people now. So Henry, very fast, that's good, I like that. So okay, you're hired again, okay? I'm gonna need a second person. Can I have a second person to be hired? You will be happy, guaranteed. No one wants to work? I predict you're gonna have a not very good professional career. So Muskan, thank you. Okay, so I'm gonna hire Henry first, okay? And I'm going to hire you as follows. Essentially, this is your employment contract. I want to pay you a bonus of $1 million if you make a return which is 5%. I call it R here, but I say 5%. Let's say R is 5%. That's I pay you a flat salary, very small, $150,000 a year. But if you make 5% return, I give you $1 million. Understand? Okay, great. What portfolio are you going to look for?
So if I'm getting like paid a flat salary and I have to just like reach that like, if I just have to reach that like benchmark return, then I would go for something like slightly more risky that will put me just over that
Okay, I wouldn't think like that.
benchmark.
What you just told me is your emotional reaction to my contract, but it doesn't really mean anything. You don't know what you're doing. So let's rewind, and everybody, let's think with Henry and try to come up with what our strategy would be. So let your hire. You start tomorrow. Okay. All right. Good. So you go to work. What time do you go to work?
But I'll assume 9.
What time?
Right?
What time?
We're doing like 9 to 5, so like 9 a.m.
You go to 9 a.m. Okay. Do you know what time markets open?
Is it
9:30.
9:30?
Yeah. So you arrive to work at 9 a.m. At that point, everybody has already put their buy sell orders. You're going to have to read everything that happened in Asia overnight, everything that happened in Europe overnight, understand what the market is, and make your decisions. Because by 9:30 it's too late. I don't recommend you go to work at 9. Okay. Do you know what time people go to work? I have a very good gauge when people go to work. If you go to Wall Street, New York, what time do Starbucks open? Starbucks knows what time people go to work. You can check online, you can ask Google. I'll tell you it's 6:30 in the morning. That's when Starbucks open in New York. What does that tell you? People go to work at 6:30. That gives you about enough time to understand what happened overnight and this and that, read the news, call your colleagues, and decide what you're going to do by 9:30, right? By 9:30 is too late. By the way, do you know what time people go to work in San Francisco? Well, let me ask you, what time do Starbucks open in San Francisco? You can check it out. What time do Starbucks open in San Francisco? Anybody has a guess?
Would it be like 3 hours ahead?
Depends on your. So you give me the time. I don't know what you mean by ahead.
So like if people in New York goes to work at like 6:30, the people in the West Coast would have to be up by like 3:30.
You're right. Starbucks open at 3:30. So if you're working in, say, in the East Coast, yeah, you can go to work at 6:30, no problem. You're working in the West Coast, you go to work at 3:30. You read the news and this and that. But okay, you read the news and you try to understand what the world is doing. You have to make your investment. What are you looking for? What are you looking for? So let me help you mathematize that. As mathematicians, when you're looking for something which we don't know, we give it a name. So the portfolio you're looking for, which you don't know, we call it a number. We call it a, typically we give it a name and it's a Greek letter. So I want to call it capital pi, and you have it there, right? And the only thing you care about is the probability that you make $1 million, which is expressed as the probability that the portfolio has a performance bigger than 5%, right? So that's what you're looking for. And you do this at 6:30, you drop by the Starbucks, you have your coffee. At 7 in the morning, you're in your desk already working. So by 7 in the morning, you write this equation. And now what? Well, I help you out a little bit. The portfolio that you're looking for, that you don't know, has a mean and a standard deviation that we don't know either. So we give it names, Greek names, mu and sigma. The portfolio minus the mu divided by sigma, if it's bigger than r minus mu divided by sigma, that's the same as to say that you got your bonus. Right? That's why the first statement in my equation is correct. And further, if I now assume that my portfolio is distributed as a normal distribution, which on your first day at work you can assume, then you can write that down with the cumulative distribution function of the Gaussian, because pi minus mu divided by sigma is independent of the portfolio. It's just the Gaussian distribution. Right? So you're almost done, because you just want to make $1 million. That means you need to maximize the probability that pi is bigger than 5, which is the same as maximizing that expression that I have there, where that's the cumulative distribution of the Gaussian, which is monotone. So maximizing that means that you need to maximize mu minus r divided by sigma. Everybody sees that? It's very simple. Except r, in this case, is in your employment contract. Sharpe ratio, Sharpe, when he wrote about the Sharpe ratio, he wrote r to be the risk-free rate of return. Well, maybe that's his ratio, but that's not yours. Yours is different. Yours is whatever number is in your employment contract that will trigger your $1 million payment. Understand? That's the Sharpe ratio. Now, let me change to now Muskan. Muskan, I'm going to give you a slightly different job. That's your employment contract. I'm going to give you a benchmark, say S&P 500, and I'll pay you a $1 million bonus if your return is 5% above the S&P 500 return. Okay? All right, what do you do? So you go to work. What time do you go to work?
6:30.
6:30, we know that. Okay, that's good. We'll learn something today. Okay, if you're investing, you go to work at 6:30. Okay, we know that. Great. But now I'm going to rewrite the same equation that I wrote for Henry does not work for you, because we had the tremendous advantage that his benchmark was fixed and yours is variable. So I have to make a slight change. What I want to say is, you see, again, as Henry, you only think about the $1 million you're going to make. That's what I pay you to do. It's not about buying stocks or buying, you don't care. You just want to make $1 million. So you want the portfolio to have a performance bigger than your index, I call Y plus R. So I do the same thing as before, except in this case, I subtract from the portfolio the mean of my portfolio minus the benchmark, but I divide by the standard deviation of the portfolio minus the benchmark. You see, that's exactly what works. Now, if my portfolio is normally distributed, that again is independent of my portfolio and the benchmark. It's a Gaussian distribution. Therefore, it's expressed with the cumulative distribution function of the Gaussian, which gives rise that I need to maximize that thing I have there. Is the excess return to the benchmark, expected excess return to the benchmark, minus your 5%, which is in your employment contract, all divided by the standard deviation of the difference, which has a name, it's called the tracking error. Now, this is very interesting, isn't it? I'll tell you the main difference between you and Henry. If I'm exaggerating a little bit, I think you'll understand my metaphor. If 1 month the index is down and you're up, you're in trouble. You may say, why is that? I'm beating the index. Yeah, I know you're beating the index 1 month. But the tracking error, as you can see, should be very small. If your tracking error is high, you're probably going to be fired. That's why mutual funds, which by the way are paid like this, you are now a mutual fund manager, Muskan. I gave you a job, which is a mutual fund. You have to beat the index, but stay close to the index, right? And that's why mutual funds, well, first of all, they're paid like that. When you see, if any one of you works for a mutual fund, you will be paid like that. And that's why mutual funds end up being very similar return-wise to the index. Because that's how you get paid. You're forced, you can see, look at the equation, you're forced to have a small tracking error. Now, this is the interesting part. So the first day at work, you do that. But the second day at work, Muskan, you have an idea. Do you know what the optimal solution to this equation is? It's very similar to the following. We already agree, and everybody please follow this argument. We agree that we need a small tracking error. So how about you put all your money, I'm going to exaggerate just a little bit. You put all your money on S&P futures. That will guarantee that if the S&P goes up, you go up, and if it goes down, you go down. So the tracking error is 0. Perfect. But S&P futures cost you nothing. You don't have to buy it. It's a futures contract. Remember what a futures contract was? Well, maybe some margin. But you have your money intact. So on the third day at work, you go to the Starbucks, also at 6:30. You meet Henry. You have a chat. What do you do? Oh, I do this. They pay me $1 million if I make 5%. They said, oh, how interesting. They pay me $1 million if I make S&P 500 plus 5%. So what you do is you say, well, you ask Henry, would you do the following, Henry? What if I give you the money, you manage it, and if you make 5%, I give you an additional $500,000. Muskan, that works for you, right?
Because I still make more than 5%.
Because if it makes 5% for you, you have the S&P return from the futures plus the 5%. You are going to make $1 million. You give half of that to Henry,
Yes.
right? And Henry, that works for you. It's the same work for you, right? To manage $1 billion or $2 billion, you don't care, the same, right? So, but now, Muskan, what do you do now? I mean, you say, well, I mean, I could have made 5%, but Henry's really good. He's going to make me the money. What do you do now? You can go on vacation for a year, come back, and ask Henry, how did we do? That's a possibility, right? Or maybe you do that the first year. You go on vacation, and this is great. You spend the whole year wherever you like to go on vacation, in the Maldives for a year, Must be boring as hell for a year, And then you come back and said, how did we do? We did great. I made some money. But then you may have a different idea. You're done with the Maldives. What do? You have nothing to do. Henry's doing all the work. You go out and say, you know what? Why don't I reach out to investors? Remember, you used to get money from Elon Musk. He thinks very highly of you. So you say, Elon, how would you like to make S&P 500 plus 5%? You say, oh, I love that. That's great. Give it to you. And then you don't have to do any work because Henry's doing all the work. You just have to meet Henry at Starbucks at 6:30 every day. Say, well, guess what? I have another $1 billion for you. Then he makes a lot of money and you make a lot of money. He's very good at managing and you're very good at selling. Understand that?
Yes.
Okay, we just created the whole investment sector. The investment sector contains two people, Henrys and Muscans. Henrys are people that just make what's called cash returns or absolute returns. They're like hedge funds. And then we have Muscans, who are people who just raise money. Okay? This has a name, it's called portable alpha. So in the world of investments, there's alphas and betas. Alpha is Henry. Absolute return strategies, hedge funds, prop desks, they just want to make money. But then you have other funds that try to replicate indices. Plus, index plus. So private equity firms, mutual funds, infrastructure funds, right? Henry lives in the world of performance fees. And you, Muskan, live in the world of management fees. And that's how the world works. We learned that today. And when you get a job, you need to understand if you're in the alpha or in the beta universe. Okay? Very important. Okay, now, this has tremendous consequences because alpha, what it does is it moves the efficient frontier up. And you know why it's called alpha and beta? It's called alpha and beta because of regression analysis. If you do the analysis of a certain fund, we find the factors that is related to. We want to understand what makes a fund go up. Sometimes it's market variables like the S&P 500, the Nikkei, who knows. Sometimes it's the volatilities. Typically volatilities make fund go down. The higher the volatility, the less well you perform. Or events. A war breaks out and then defense stocks go up. The understanding of what the investments are a function of is a very rich area, very important. And it's done in many different ways. I'm going to explain to you linear regression. I don't have to tell you that there's other methods like tree regression or support vector regression or things like that. You already know. Okay, so let me stay with the simple ones because it's not the techniques that I want to focus on, it's the concept that I want to focus on. Okay? So some investments are hedged and not directly dependent on external events, like for example our snow fund. The snow fund made us 10%, 7.2%, independent of what the market does. So it would have been a very good candidate for Henry if he could do it. We don't know if his portfolio guidelines allow him to do that. But others are dependent on external events. Like for example, in your case, Muskan, you have to be pegged to the S&P 500. It's part of your job description, right? So when you have a fund, such as for example this one, the one in blue, we can see that it depends on a risk factor, the one in black down there. And then this fund gives us a very nice alpha in addition to that, which I find through regression analysis. And you've done regression analysis many times. So regression analysis in the case of investments is the one that tells me what risk factors I'm exposed to. And you can do this in one dimension or in several dimensions. And I mean, you know what this is. If I have a return and the consideration, I can analyze my investments by figuring out what's in it. And that's how I get my alphas and betas with respect to that. And that's where the term alpha and beta is used in this context. And you know that the betas are related to the covariance. In fact, they are solved as a system of equations. And I think all of these things you have seen. I'm just making a connection between the world of investments and what you may already know about investment parameters. And you know that this is done through least squares, minimizing least squares. This is least squares regression. And I could do the same thing for other types of more advanced, perhaps machine learning focused methods to classify or to get explicit dependency. You already know that. In fact, we saw that earlier in this course. The same thing applies, but linear regression is easier to understand. And you can do this in higher dimensions where you can see that certain funds would depend on a combination of other factors, sometimes long, sometimes short. But the world of investments is made up of two types of players, Henrys and Muscans, alphas and betas. Okay? We're done.